Okay, so today's topic is monetary policy, analyzing the short and long-term effects of this on the U.S. economy. So it says fiscal and monetary policy. We're going to talk about monetary policy today. We'll get into fiscal policy for the next video and explain the differences between those two things. But as yesterday's or the last video told you, our economy moves through economic cycles, and the government, the role of it in our mixed economy is to try to manage that business cycle so things don't go too fast, things don't go too slow. One aspect of that management is called monetary policy. What is it? It's changing the rate of growth of the money supply. How much money is out there in circulation that affects the cost and availability of credit, which is your ability to borrow money, and therefore how much money you can borrow affects how much money is out there in the economy being spent. So all these things. How much money is in circulation, and how much money is in circulation affects how easy it is for people to get loans. When people get loans, there's more money being spent, and that can affect obviously a number of things in our economy. So who manages this? Well, it's the Federal Reserve. It's the central bank in the United States, and it's known as the Fed. The chairman of the Fed controls and coordinates the Fed's activities. This chairman is appointed by the president and confirmed by the Senate, as well as all of his board members, the board of governors who help this Fed chairman do his job or her job. Ben Bernanke was the last Fed chairman, but now for the first time in United States history, we have a female chairman of the Federal Reserve. Her name is Janet Yellen, and she was just approved in 2013. They serve terms that exceed the length of a president's term. There's no guarantee that a president will get to appoint a Fed chairman. For example, if Barack Obama had not been reelected, he would not have had a chance to appoint a Fed chairman during his term. So this leader of the Federal Reserve is an independent regulatory agency. Once the person gets their job, they cannot be fired by the president. They cannot be fired by the Senate except through an impeachment process, which would be somewhat unusual. So the Federal Reserve System is controlled basically by this person. He controls the money supply in the United States. It makes for a very powerful role, especially economically speaking. Some people will call him the second most powerful man in the world, if not in the United States alone. The chairman gets assistance from the Federal Open Market Operations Committee. It's the group that helps determine what the policy should be, how the money supply should be manipulated. There are 12 members. They each represent a different region of the country. Therefore, we don't just have one guy in the Board of Governors in Washington, D.C. deciding what's good for Alaska and Hawaii. They get input from the different regions of the country so they can find out what economic conditions are like in St. Louis and North Dakota and Nevada before they make decisions that are going to affect everybody. Maybe you've got a economic downturn in Florida. Is that a reason to make a policy change that's going to affect the rest of the country as a whole? Something they can all discuss and consider. Here are some functions of the Fed. They have regulatory functions. They oversee and regulate large commercial banks like Wells Fargo, Bank of America, BB&T, Fifth Third Bank. They make sure that they're following the rules that are put in place by the Fed. They enforce laws concerning consumer credit. If Bank of America is going to give out mortgage loans or credit cards, ways for consumers to borrow money, they have to follow certain laws. Those laws will be enforced by this part. This is, after all, part of the executive branch of government. They help enforce laws. They act as the government's bank. The government holds its money there. The money that gets paid out to employees, money that comes in through taxes, is kept at the Federal Reserve Bank in the United States. They sell U.S. bonds and treasury bills. If you've ever been given a U.S. savings bond, well, it's the Federal Reserve that sells those savings bonds. When you're doing that, when you're buying a bond or a T-bill, treasury bill as they call them, you're lending money to the United States government with the idea that they will pay you back with interest in time. They manage the currency, as we mentioned before, the money that's out there in circulation, and they act as the banker's bank. Commercial banks borrow from the Fed. If Bank of America needs money, they turn to the Federal Reserve to get that money. And how easy it is for them to get that money can help determine how much money ends up being in circulation. So there are two main policies that the Federal Reserve can handle. They can have a loose or easy money policy, or they can have a tight or hard money policy. When they have a loose money policy, the money supply is plentiful. There's lots of money to go around, and hey, that makes people happy. They like having money to spend, at least temporarily. It stimulates the economy. If they make it easy for money to be available, it's going to make the economy move faster. More goods and services are going to be bought, at least in the short term. But it's not all good. Unfortunately, if they print too much money, if they make money too easy to get, inflation will start to rise, because just creating more money does not create more goods and services. That just means that there's more money out there chasing the same number of goods and services, and that's going to cause prices to go up in a very short period of time. So that would be a negative. Everything begins to cost more. That's the result of inflation. And on the other side, they could practice tight money. They're not going to be handing it out, but they're going to be holding on to it and making it hard to get. When they do this, the money supply is limited. You're frowning over here because, you know what, not as much money flowing through the economy. That makes everybody feel like they don't have as much to go around. But it helps to control inflation. It keeps there from being too much money in circulation. If they're practicing tight money, it doesn't mean that they won't allow any new money into the economy. They're just going to let it try to keep up with the production of more goods and services. As our GDP rises and we produce more goods and services, more money can be added in, and that would keep prices stable. But if more money is added in than goods and services, you're going to end up with inflation. Tight money, therefore limiting money in circulation, will help to control inflation. But another negative of this is it can slow economic growth, which is a bad thing. You're going to frown when the economy is slowing down, but sometimes they want to slow the economy down. If they feel it's starting to move too quickly and it's in danger of overheating and leading us into a big recession or depression, they may try to back off on the money supply, just to try to slow things down a little, not get them to decrease, but to slow the economic growth down. So what are the tools that they have to do this? There are three tools of the Federal Reserve. There is the discount rate, the reserve requirement, and open market operations. The end. Just kidding. Got to explain what these things are. Good joke, huh? All right, so the discount rate to begin with. This is the interest rate that the Federal Reserve, charges banks on its loans. It's the banker's bank. When Bank of America needs a loan, they come to the Fed. The Fed gets to determine what interest rate they're going to charge Bank of America. Currently, this rate is set at 0.75%. So if Bank of America wants to borrow money, they have to pay a 0.75% interest rate. That's a very low interest rate right now, and it reflects easy money policy. If the bank borrows $100, they're going to have to pay back $100.75 when 1 year is up. Therefore, there's very little cost to borrowing that money. It's very cheap to borrow money. You basically just have to give back what you borrowed plus 75 cents. Not a big cost. If you increase the discount rate, make that number higher, you're going to slow the economy down. Why? Well, it costs more to borrow money. Because if you make it 10%, you're going to have to pay back $110 in 1 year, not $100.75. That's going to slow the economy down, because banks will either borrow less money or they won't borrow at all. That means there's less money in the banking system, less for them to lend out to consumers and businesses. On the other hand, if you decrease the discount rate, drop it down to zero, say, or it's low enough as it is, that can stimulate the economy. Why? Because it costs less to borrow money. Banks will not think so hard about taking those loans out because they're not paying much back in rate. So controlling the discount rate, the interest rate, banks are going to turn around and set their interest rates based on how the Fed sets their discount rate. That's going to determine how much it costs you to borrow a car, get a loan for a car, how much it costs your parents to get a loan for a house, how much it costs a business to get a loan to expand. The next tool of the Federal Reserve in controlling our money supply is called the reserve requirement. This is a certain percentage of deposits the banks have to set aside as cash in their own vaults or as deposits in the Federal Reserve District Bank. So we know, we've discussed this before, that when you make a deposit at a bank, the bank turns around and lends that money out. They don't just keep all of your money in a safe. Well, a certain percentage of the money that you deposit must be kept in the bank. And what percentage they must keep affects how much can be loaned out. So this is one tool the Federal Reserve has. They can require banks to keep a certain percentage. Currently, they require 10%. That means if you deposit $100, they have to keep $10 of it in the bank, and they can loan the other 90 out. If they increase the reserve requirement, if they up that to say 50%, that's going to slow the economy down, because now if your $100 deposit is made, they must keep $50 in the bank, and they can only loan $50 out into the economy as opposed to $90 that they could loan out when they only had to keep 10%. That means there's less money out there for car loans, for home loans, for business loans. That's going to slow the economy down. Less money out there in circulation. Tight money. Why? Banks have less money to loan and invest when the reserve requirement is increased. However, they can also decrease the reserve requirement, and this would stimulate the economy. Why? Well, it's going to make it easier for them to loan money out because they're keeping less in their bank. So here's the example: $100 deposit with a 10% reserve requirement. $10 is kept in this vault up here. The other 90 is loaned out into the economy. Increase it to 50% as the reserve requirement. Now $50 is kept in this vault, and only 50 is available to loan out. Money is tighter, not as much money available to loan or invest. Decrease it, knock it down to 5%. Now they only have to keep $5 in the vault. $95 they can lend out. Loose money, more money out there to loan and invest. So the Federal Reserve can set this requirement, and that can affect how much money is out there in circulation. All right, the final tool is open market operations. This is the purchase or sale of U.S. government bonds and treasury bills. Anybody ever seen one of these before? It's a U.S. savings bond. You might have one. Well, you're loaning money. If the Federal Reserve decides they want to sell bonds, okay, they need to borrow money from the public as a whole because we're in debt. We need to pay our bills. So they're going to sell bonds to raise that money. That's going to slow the economy down. Why? Well, people have to buy the bonds. Your brothers, your sisters, your moms, your dads, businesses. They go out and buy the bonds. That removes money from my pocket, from your pocket. It takes it out of circulation and puts it in the government bank, essentially. That means there's less money in circulation, less money to be spent. That's tight money, removing money from the circulation. On the other hand, the Federal Reserve could say, you know what, we're not going to sell bonds anymore. We're going to start buying them up. That can stimulate the economy because now they're going to go around and be buying these bonds back from people. People get money from selling their bonds, and there's more to spend and save in the economy. That increases, that's loose money, more money available. When there's more money available, that's stimulating the economy. All right, so these are the three tactics that are used. We'll work with these some tomorrow in class. You can try it out. It's a very tricky game that the Federal Reserve plays in terms of not having too loose of a policy, not too tight of a policy. Had a very loose policy overall, specifically by doing this over the last few years, buying back treasury bonds referred to as quantitative easing, and by lowering the interest rate down to as close to zero as you can pretty much get. The reserve requirement is not something that they play around with all that much. It's generally the first and the third, yet this is a tool that is available. All right, that's monetary policy, controlling the amount of money that there is in the economy. And you can watch the quick 2 or 3 minute video here that might explain some of the other effects of what happens when the government prints money.
Prices rise when the government prints too much money. The 1970s were a period of steeply rising prices, or inflation.
At the worst, in the late 1970s, inflation was running at 10%. That means the average price in the economy, typical price, was rising about 10% per year. The 1970s, inflation started with some shocks driven by OPEC, the Organization of Petroleum Exporting Countries. Oil prices skyrocketed, and that started inflation in the United States.
Economists define inflation as a rise in the overall level of prices.
Inflation is any time the supply of money has increased by, say, the government printing more money, so that we have more dollars chasing the same number of goods, and the price of goods rises simply to reflect the increase in the amount of money that is available. That's classic inflation.
The Federal Reserve Board in the United States determines how much money is in circulation. It's very tempting to print lots of money. If you print lots of money, people temporarily feel wealthier. Politicians generally urge the Federal Reserve Board, historically have urged the Federal Reserve Board to be easy with money, to print lots of it. Why not? It doesn't cost anything to run the printing press other than a little bit of electricity and a little bit of paper, and yet it makes people feel good when the bills are floating around the country. In the long run, actually in the medium term, within months, if the Federal Reserve Board is not responsible, if it's printing too much money, then that begins pushing prices up in the economy.
As money becomes more available, its value shrinks and prices rise. Once inflation starts spiraling upwards, it's hard to get it under control.
In the 1990s, we haven't had very much inflation, and the main reason is that we've had a lot of stability in the money supply of the United States. The government hasn't been printing a lot of extra money, and goods and services have been growing at about the same rate as the amount of money that's available in the economy. And if they grow at about the same rate, then we don't end up with very much inflation, because we never have this situation where we have too much money chasing too few goods.
The slow inflation of the 90s is a result of vigilant anti-inflationary policies at the Federal Reserve. It has slowed down the printing presses and maintained slow, stable growth in the quantity of money circulating in the economy.